good afternoon, everyone. Thanks a lot. Good afternoon, by the way, and also thanks for joining for those from different time zones. Good morning to those. My name is Laura Stevens. I'm a managing director at Board of Innovation. Thanks a lot for taking the time to be here. In this webinar, we are going to explore how AI is reshaping competitive dynamics, how it's disrupting business models, and also changing the economics of certain industries, which also explains why most of today's enterprise AI strategies are actually missing the point. As always, we'll also share some ideas around how to respond. Looking very much forward to this session together. Maybe as usual, a few practicalities before we begin. On the next slide, for those of you who don't know BOI, we are an AI transformation studio, and we are focused on helping organizations to grow and to compete through AI or within an AI-driven market. And to get there, we work with our clients across two main dimensions. So first, we design and we build AI-first products, services, business models. And secondly, we also help companies to transform how they operate, how they deliver their services, but also how they market and sell in an AI-driven world. The webinar is being recorded and we'll be sharing the replay with you afterwards. So if I move too fast, and I definitely do, for those of you who know me, you will be able to replay me at a normal pace afterwards. Also, feel free to drop your questions in the chat at any time. My colleague Nick will keep an eye on them throughout, and if all goes well, we'll also have some time at the end for a Q&A. So let's get started, and we'll start with an observation that we tend to call the comfortable illusion, and that is that most companies today are treating AI as a tool or as a productivity upgrade. What does that mean? They see AI as a way to make their existing operating model more efficient, rather than rethinking whether that operating model still makes sense. And so then we see that their AI strategy typically is a list of use cases, which often came together through a lot of bottom-up ideation, often with a very strong bias towards quick wins, efficiency gains. And often a very big part of their efforts is focused on things like running pilots, rolling out co-pilots, creating task forces, training employees, et cetera, et cetera. And that's also what you'll see almost in every traditional consultancy playbook on enterprise AI. Now, there's nothing wrong with these activities, and they are all very important, but they are not enough. And the reason for that is quite simple, and that is that AI drives quite a structural and profound shift in how organizations operate, how they grow, and how they compete. And that is because AI, and we can go to the next slide now, AI is not just a tool, but it's something that economists call a general purpose technology, which is much more similar to the internet or to electricity. And so we know that these technologies did not just improve existing processes, right? We know that they reshaped entire industries. And so if we look at the history of these general purpose technologies, we know that they tend to come with three major shifts, which you can see on this slide. First, they enable entirely new business models. So not just better versions of what already exists, but actually fundamentally different ways of creating and capturing value. So just think about how the internet, for instance, gave rise to e-commerce or to social media-driven business models. Second, these general purpose technologies, they also change cost structures. What do I mean by that? When tasks that used to require a lot of human time and expertise can now be automated and can be delivered at scale, they obviously become much cheaper to produce. And so what once took hours of a lot of skilled workers can now be done in minutes just by an AI system. And so that has a few very profound implications, which I'll discuss throughout this session. And then finally, as you can see on this slide, these general purpose technologies, they also drive changes in what defines competitive advantage. So while companies used to compete or still compete on things like capital or size or brand or reach, we know that these things become less important in an AI-driven economy, and that competitive advantage actually shifts to things like proprietary data or process and workflow integration. So if we understand AI through that lens, then the conversation actually moves quite fast beyond efficiency, and it elevates it to a more strategic and almost to an existential level. If we go to the next slide, I would say that this is also where many companies actually get stuck, and why exactly an AI strategy that is just a list of use cases misses the point entirely. Because it essentially means that you're applying operational thinking to something that is a very profound and structural shift. So you're trying to optimize your current model instead of just questioning whether that model itself still holds. And so the bottom line is that a structural shift can never be addressed with an incremental logic, which is unfortunately what we often see in companies. And so treating AI as a toolbox or a toolbox upgrade really misses that bigger redesign opportunity. And I would also say that in a world where competitors are redesigning, that gap is becoming quite dangerous. If we go to the next slide, what we've seen is that general purpose technologies come with changes to business models, to cost structures, and to what defines competitive advantage. And so these changes also explain why certain business models today are being disrupted. And so today we're going to look at 3 structural ways in which AI is already kind of disrupting markets. The first shift, AI shifting control from humans to algorithms. What do I mean with that? Most markets today are structured or based on the idea that humans are the primary decision makers when it comes to purchases, right? So humans are the ones who compare options. They do it imperfectly. Humans rely on brand recognition because we're impulsive creatures. We are influenced by marketing. We have limited information processing capacity and so forth. And so the entire idea of marketing and sales and pricing, but also positioning, are all designed around the idea that humans are making the decision. Now, we all know that today AI is increasingly mediating how choices are being made. We have algorithms that are ranking products. We have AI recommending suppliers. And so the result is that power is increasingly shifting away from individual brands or providers to platforms and to systems or companies that own those algorithms. And so if you don't control that algorithmic layer, you're no longer actively involved in shaping the customer decision. We'll discuss in a little bit that this trend is driving a lot of price pressure, margin compression, but also profound changes in influencing mechanisms in the space of marketing, and it even leads to the removal of certain market layers. Second disruption, AI lowers the barriers to enter those markets. For those who follow the AI fields, shouldn't come as a surprise. We know that capabilities that once required scale and expertise or large teams are now broadly accessible through AI. And so the result is that new entrants can emerge and they are built up from the ground with AI at their core. And so that means that they can operate faster, leaner, and also at a structurally lower cost base. And so what we see is that competition is increasing and traditional players are getting pressured. Final way in which AI disrupts is it's driving changes in what customers are willing to pay for. AI makes knowledge, content, code much cheaper to produce. And so these things become less scarce because it basically becomes cheaper for everyone to produce the same product or service. And so one of the simple laws of economics, which still stands today, is that when something becomes less scarce, customers are less willing to pay premium prices, right? And so any business model that is built on the idea of time monetization or product licensing starts to come under pressure. So control shifts, competition increases, value moves. And so those are some of those structural resets that AI is driving. And again, they explain why this is not just a technology wave, but a market reset. If we go to the next slide, we're going to deep dive a little bit into each of these ways that AI is disrupting business models. Let's start on the next slide with the first way. So, and that is by reallocating control. So AI is driving a shift from power to whoever owns the algorithmic layer. There are roughly 3 manifestations, I would say, of that control shift that is driven by AI. The first, which you see on the left side of this slide, and that's already happening at scale, is that AI is actively starting to shape our purchasing decisions. We know that more and more customers don't start their search on a brand website. They start in ChatGPT or Perplexity. And so they ask, what is the best CRM for a mid-sized company, or which insurance provider has the best coverage, or what's the best laptop under €1,000 or dollars. And so AI doesn't show 20 ads, at least for now, but instead it summarizes it, compares, it filters, it recommends. So humans still make the final decisions, but the set of options that we consider and how they are framed is shaped by an algorithm. And so when that happens, there are a few things that follow. The transparency increases. It becomes much easier for customers to make a comparison. The competition intensifies. People are getting put under pressure in terms of prices. And so margins get under pressure. And even worse, if you're not surfaced by the algorithm, you may not even be considered. So that's the first shift, AI shaping decisions. The second shift, which you see on the in the middle of this slide, goes a little bit deeper, and it's when AI does not just shape decisions, but it actually increasingly starts to execute and to optimize them. So think about AI books the flights, AI selects the supplier, or AI renews the subscription. For instance, in procurement, we know that AI is increasingly being used to evaluate suppliers, whether that's on price or availability or reliability. And so it recommends the optimal option, often still with human approval, but we expect that to change over time. And so here it's actually the influence that starts to shift to whoever controls the system that is actually acting on your behalf. And so in these kind of markets, what we see is that suppliers become interchangeably faster, so switching costs would drop. The impact of brand loyalty starts to weaken, performance metrics start to dominate purchasing decisions. And so competition actually moves from convincing people to making sure that you're selected by systems. So that's a much stronger commoditization force. And then the final shift is the most structural one. AI doesn't just shape or execute decisions, but it can also remove layers entirely, especially those layers that don't add a lot of value. They only add coordination or production efforts without owning any defensible or unique assets. What do I mean with that? We know that AI is removing layers that are just about generating basic content, are just about aggregating information, are just about comparing options. A good example, I think, is content production agencies. If your value is writing standard blog posts or creating basic ad copies or producing simple visuals, AI can now generate that directly, and so that production layer may shrink or disappear at all. Of course, important to say here, not all intermediaries or middlemen are vanishing. Some people, for instance, argue that platforms like Booking.com could be bypassed now that AI is matching supply demand directly. But Booking is much more than a middleman. They own massive behavioral data sets. They control real-time hotel availability APIs. They manage payments. They control distribution and traffic. So that is a much more defensible position. So context is key here. If we go to the next slide, one of the most tangible examples of decisions being shaped and potentially being executed by AI is what is happening in e-commerce right now. Agentic commerce is evolving fast. Yesterday's chatbots were mostly support tools. They were quite reactive and limited, or answering just basic questions. Today, the assistants already do much more. They are explaining, filtering, comparing, recommending, and increasingly guiding you straight to checkout. And then we're probably also moving to a world where the assistant eventually itself becomes the storefront, meaning that it won't just suggest products, but it will bundle options, personalize offers, and also negotiate preferences, and even complete the purchase wherever the shopper is. And so at that point, brands are no longer competing for shelf space, but they are competing to be selected by the agents. So that's what we call mediation. The interface becomes the decision maker. On the next slide, you'll see what we're seeing today is probably just the beginning. Right now, we are in the phase of purchase in chat in the US through things like instant checkouts. For the participating merchants, AI assistants can already complete transactions inside the conversation. So customers can basically search, they can select, they can buy without ever leaving the chat interface. It's already a very meaningful shift, but further down the road, we're most likely going to evolve towards autonomous agents, where the AI doesn't just help you to complete a purchase, but it starts to manage the entire journey from discovery to comparison to checkouts with minimal customer involvement. And beyond that, we're likely even to move to an agent-to-agent commerce, where your AI agent will directly talk to brand agents and start to negotiate options, check availabilities, compare bundles, and complete the transaction on your behalf, often proactively with almost no input from you. And so at that point, customers are no longer actively navigating markets, but their agents are. On the next slide, a few words about the implications, right? Everyone is now optimizing for visibility, but the implications of agentic commerce for sellers and retailers are much more profound in my perspective. So first, sellers will no longer have to optimize for human shoppers or single platforms. They will need to optimize for AI agents. and each of these different agents will have different preferences depending on which model or which platform is being used. So these agents are going to act as the middleman between you and the customer, meaning that you'll continuously have to adjust your approach to meet the different demands. Second, as already mentioned, we will be seeing margin erosion because AI agents sit between buyers and sellers. They'll be capturing a share of the value. This means more volume, but at the cost of thinner margins. Third, data monetization will get at risk. What do I mean? The rise of zero-click research also means that customers can get the information they need without ever visiting a website, which is also likely to erode direct traffic, leaving retailers with less access to customer data and less ability to understand or influence that behavior. And finally, revenue streams will be threatened, especially traditional advertising-based monetization models will start to weaken. Instead, value is going to shift to AI visibility optimization, where sellers compete for visibility inside the AI ecosystem. So very clear that sellers, retailers will have to start rethinking how they reach their customers, how they capture value, and how they protect their margins. On the next slide, let's maybe take a closer look at when or where that commoditization or mediation hits hardest, because it's true that not all industries or business models are being affected equally. We know that AI has the greatest impact on markets that are comparable, that are measurable, and that are also frequently optimized. So what do I mean? First, the market is comparable. So if the core product is very standardized and multiple suppliers can meet the same needs, then substitution basically becomes easy. So AI can make comparison recommendations much faster and more accurately than humans, pushing basically everyone in the market towards the same offer. Second, AI commoditizes fastest when the buying logic is mostly centered around price. When price is the dominant factor in buying decisions, then optimization starts to matter more than uniqueness. For me, an example is, for instance, energy. I'm the worst possible person in comparing all potential energy providers. So for me, price is actually the only thing that matters. And so in these kind of markets, AI is very effective at optimizing just based on cost, so that sellers are forced also to compete on price. And then third, in case where the decision-making environment favors AI, what do I mean? Markets where decisions are high frequency, where options are complex, and performance is also measurable. They also create an environment in which AI mediation actually excels. We know from neuroscience that humans struggle to process a lot of information, or they struggle to analyze complex options quickly. Think about telco bundles, again, energy tariffs, but AI algorithms can handle it. And so they can do it at a fraction of the time that we need as humans, making it the ideal tool for those environments. So already gave a few examples: telecom plans, bundles, energy procurements, cloud usage, energy trading, all examples of environments where AI actually is a great help in mediating purchasing decisions. On the next slide, and as mentioned, AI is not just reallocating control inside markets, but it's also reshaping who can actually enter the market in the first place. And it does that by dramatically lowering the barriers for new entrants to enter the markets. And this is definitely not a future trend. It's already happening. We'll dive deeper into this second order disruption on the next slides. So we're seeing the rise of new competitors. For those of you who follow the fields, this shouldn't come as a surprise either. We know, again, as already mentioned, that in the past, being successful in a market required either large teams or significant capital or deep expertise. And AI is now dramatically reducing the cost of building products, of coordinating efforts, of scaling expertise. And so you actually no longer need to have a scale or massive headcounts to compete effectively. The first thing is, as you can see on this slide, coordination costs are collapsing. So AI enables smaller, leaner teams to actually coordinate their efforts far more efficiently than traditional players. And so these companies actually move faster because AI handles the core tasks and processes, meaning they don't need all the layers of management or manual processes that larger firms typically rely on. Second, production becomes software defined. What do I mean? AI makes it much easier to start a company and build a product. Again, I'm repeating myself, but what used to require a significant time, capital, specialized expertise can now be done faster and at a lower cost. I think writing software, creating marketing materials, AI really enables those small teams to accomplish what previously required much larger teams. And so these companies can scale very quickly. They build fast, iterate with far fewer resources. And as a result, they need fewer people with less capital to bring something valuable to the markets and also compete in those markets. This is not fiction. We're already seeing AI native companies, or solo unicorns, as some people say, that are generating substantial revenue with only a fraction of the workforce that traditional firms would require. And there's a lot of talk today about the rise of the so-called solo unicorns, the one-person companies that are powered by AI that could, in theory, reach billion-dollar valuations. While I personally haven't seen like a true solo unicorn, we are starting to see signals of what's possible. And I think on the next slide, a good example is Base 44. It's a company that was founded by a 31-year-old developer as a kind of a side project using vibe coding. And so in just 6 months and without raising any outside capital, that company grew to 250,000 users. It became profitable, and it actually generated more than 3.5 million in ARR. And so only after 6 months, it was acquired for 80 million in cash. Now, it wasn't literally a one-person company. I think it was about 8 people. But that's exactly the point, right? A team of fewer than 10 people built, scaled, and exited a company at a valuation that traditionally would have required dozens, sometimes hundreds of employees and significant venture capital. So there's also a lot of things that are exciting about this wave. But I think what this example shows is that AI dramatically compresses the resources needed to build, launch, and scale a company. And when the cost of building drops, barriers to enter fall and competition increases. So that's quite a structural shift. On this slide, another example of the shift is Basis AI. That's also an AI native company that reached a 1 billion valuation with a very lean team, at least much leaner than traditional service companies would require. What makes the company unique is that it's not a typical accounting software vendor, but it's an AI-first platform that is fully built around autonomous agents that can actually handle end-to-end accounting tasks from document review to tax return preparation. So this is really a new breed of competitor, and it operates with a fundamentally different business model, a different scaling logic, and an extremely high revenue per FTE. The next slide, a final way in which AI is disrupting business models is by changing what customers are willing to pay for. Historically, businesses, or still today, businesses are selling products or services mainly based on units or time. So what do I mean with that? You pay per product, or you pay per hour, or you pay per seat, or you pay per project. And customers are essentially paying for effort, right? Time spent, documents produced, code written, reports delivered, meaning that revenue is, for many businesses, directly linked to human effort or to physical production. Now, when AI generates those outputs instantly and at a very low cost, something changes, right? So people start to wonder, why would I pay 5,000 euros for a market analysis if AI can produce a comparable report in minutes? Or if an extensive coaching report can be generated in seconds, then why would a customer still pay a premium price for the report itself? In the same line, if a marketing copy or legal drafts or financial analysis or software codes can be produced almost instantly, then customers begin to question what they are really paying for. So again, when the cost of producing knowledge drops, the willing to pay for that production drops as well. And so what we see is that customers shift from paying for effort to wanting to pay for outcomes or wanting to pay for real impact. And that's the disruption here. So AI is not just reducing costs, it's changing what is perceived as valuable. And that has a few implications. If we move to the next slides, the first manifestation is that we see the erosion of the so-called monetization of human time. For many companies, billing effort or billing by effort or by hours is no longer a sustainable model, right? So as AI is starting to automate more tasks, that growth starts to become decoupled from headcount, making it harder to defend such a business model that actually relies on charging by the hour or by employee. And the bottom line is often that customers no longer want to pay at least premium prices for time spent. Two different manifestations. One, in some cases, AI directly replaces the need for services that were historically performed by humans, in that they can now be done by AI at a fraction of the cost and time. Examples: basic design, translation, entry-level legal drafting. So these tasks are easily automatable. And so basically meaning that businesses can no longer rely on human labor or junior talent for these roles. In other cases, think professional services like consulting, like legal, accounting. AI does not necessarily replace the entire function, but it starts to erode the reliance on human time, meaning that AI primarily impacts things like billable hour revenue or junior leverage or the typical pyramid-based staffing models that we see in consulting, right? So AI is very unlikely to go to fully replace these jobs, but it's automating repetitive cognitive tasks, leading to few hours built. So that means it basically directly compresses margins by reducing the dependency on human labor, especially for junior roles. This is a real trend, the compression of billable labor, and it's also reshaping how service-based industries are making money. We know that many consultancy firms, for instance, already start to feel or expect pricing pressure on billable hours, and so are actively exploring more value-based or subscription-based pricings. Second manifestation, we see a shift also in asset-based monetization. What do we, the slide is not moving, I don't know. Yes, thank you. So a shift in asset-based monetization, what do I mean with that? Traditionally, companies are selling physical products as a kind of one-off transaction. So you buy a washing machine, or you buy a tractor, or you buy an industrial compressor. And so the transaction basically ends at the delivery. Now, in an AI-driven world, that becomes insufficient, in the sense that customers increasingly expect more than just the product. They expect performance, right? Availability, continuous value. I think one of the examples is home appliance, right? In the past, you just bought a washing machine, that was it. Today, smart appliances are able to monitor usage, predict maintenance, optimize energy, and et cetera, et cetera. And so even automatically reorder things like detergents. And so the product becomes part of a service ecosystem. And so customers may start paying not just for the machine, but also for commitments like guaranteed uptime or energy efficiency and so forth. Maybe just a proactive reflection. Of course, we know that servitization is not new, but what changes is that AI at least changes the feasibility and the scale of performance-based models, right? Again, another example is industrial machinery. Instead of selling a machine, manufacturers can now move at scale to things like power by the hour, uptime guarantees, predictive maintenance contracts, etc. With AI, machines generate data, AI can predict failure, AI can optimize outputs, and so the customer doesn't just want the assets, it wants output and reliability. Another example, which probably most of you know, is Rolls-Royce, the jet engines. Airlines don't buy engines, they buy hours of trust, and the manufacturer takes responsibility for maintenance and uptime. And that same logic is actually now spreading across industries, even in construction equipment, agriculture, manufacturing. Even in pharma, we see companies starting to think about more outcome-based pricing and so forth, right? So in both the service-based and the asset-based industries, the shift is similar. It comes down to the fact that companies move from selling discrete units or hours or assets to offering more continuous integrated outcome-based solutions. If we go to the next slides, just to make it tangible again, in case you didn't fully understand, for service-based companies, this often means a shift to a service as a software. Sorry, I'm still talking about the previous slides, Sina. Realize this is confusing. On the left side, you see that for service-based companies, that often means a shift to service as a software. So let's take the example of a player in assessment and coaching. Traditionally, these companies, they offer human-delivered services like one-on-one coaching or like in-depth assessments or personalized feedback, typically charged by the hour or a package of hours. With AI, many of these aspects, like the generation of feedback or the generation of development plans, can now be automated without the need for human intervention in every interaction. So that means that instead of billing for human hours or expertise, these companies can now move towards offering a more productized and a more scalable version of their services, which is no longer dependent on individual coaches. Maybe important to highlight is that shift, because we're working with quite a lot of service-based organizations, that shift goes far beyond how services are delivered, but it also requires these companies to rethink their pricing structure. The traditional model works with hourly rates based on human labor, but in an AI-driven model, these companies move to subscription-based or access-based pricing. Now, let me be clear there as well, unless the offering delivers differentiated outcomes or proprietary value, then also subscription models themselves come under pressure, which is what we're currently seeing in SaaS. We're going to discuss that in a bit. So this is quite a profound shift for service-based organizations. It really forces companies to rethink what customers are truly willing to pay for and how they can monetize that. On the right side of this slide, you see that for asset-based companies, the shift often means moving away from selling products to selling outcomes. And so instead of selling physical products, businesses are moving to models like equipment as a service or materials as a service or even infrastructure as a service. The bottom line is that the focus is shifting to continuous value delivery rather than just product sales. Just to make it concrete, on the next slide, another example in machinery. The old model is about selling machines. So we sell machines or materials, and so the revenue model is directly tied to the volume sold. More machines, more units sold means higher revenue. Revenue is typically based on CapEx sales, so selling machines, for instance, or spare parts, maintenance contracts, and so the risk sits with the customer or the person who owns the equipment. Today, performance becomes measurable at scale as a result of AI. And so it's driving changes in what customers expect. In particular, we see that customers now expect things like guaranteed uptime or output-based contracts and so forth. And looking ahead, we will see that their growth models of these asset-based companies will be less and less tied to production volume or units sold and move to being tied to operational outcomes. Before we move to the final section of this webinar, where we discuss how to respond, let's briefly talk about what's happening in SaaS on the next slide, because we cannot give a webinar about AI disruption without talking about SaaS-based models. So for a very long time, building software was expensive, it was slow, you needed large engineering teams, big budgets, long product cycles. And so that was what created the real barriers to entry, right? It also created strong pricing power for software companies. Now, AI is changing that. And this shift is kind of accelerated quite dramatically over the past 2 to 3 years, I would say, in the sense that AI's coding capabilities have advanced to the point where AI can actually generate substantial portions of code with humans supervising and refining the outputs. So today, developers are no longer writing everything line by line. They're supervising, they're prompting, they're refining. Even companies like Spotify or Anthropic, they openly say that a large share of their code is actually being written with the help of AI agents. Now, of course, just to anticipate, that doesn't mean that engineers are obsolete, but it does mean that the economics of building software are changing. Again, what used to require 20 engineers may now require 5. What used to take months can now take weeks, etc. So here again, 2 things happen at the same time. First, the barriers to entry fall, becomes easier for new competitors to enter the markets. Second, when it becomes easier to build alternatives, customers become less willing to pay premium prices, especially if the product is nothing more than a thin wrapper around functionality AI that AI can generate directly. So that's the supply side effect, but there's also a demand side disruption. A lot of these SaaS companies, they price per seat, per user per month. A model that assumes that value scales with the number of human users. AI, again, breaks that assumption, because if AI allows smaller teams to do the same amount of work, then fewer employees need direct access, and so fewer seats are required. So the issue here is that value creation becomes less dependent on the number of users, and so any pricing model that is tied to the number of users becomes under pressure and will affect how scalable your pricing model will remain. In any case, as you can see on the right side, financial markets are starting to reflect these structural concerns. We've seen more negative stock ratings on SaaS companies recently, because investors are worried that margins will increasingly come under pressure, that software will become easier to replace. Of course, again, to anticipate doesn't mean that all SaaS companies are equally vulnerable. Some have real moats. I'm not going to go deeper into that for the sake of time, because I see that I'm really behind. So we'll try to even accelerate. I know that many of you probably don't like to hear that, but still. Next slides. So how can you assess whether your business model is at risk from AI? Will be a little bit of repetition, but we've developed an AI disruption index, which is also online, that consists basically out of 8 categories that we believe you should consider when evaluating AI's disruption potential. It's something that you can really use. It's a practical framework to discuss with your executive team or leadership team to really understand where your model is most vulnerable to AI disruption. It has things like operational exposure, meaning how much of your work is template-driven, repetitive, focused on information handling. Accounting is a good example, because a significant part of traditional accounting work involves collecting invoices, preparing standardized financial statements, drafting tax filings. So the work is super structured, rule-based, template-driven. Clearly a disruption. Of course, there's also the business model itself. So ask yourself, to what extent is your value creation and your revenue tied to human time and scarce expertise? We've discussed that quite extensively throughout this webinar. We've discussed interface disintermediation. Offerings are most vulnerable to disintermediation if your offering is easy to compare based on measurable criteria, if customers choose you mainly based on price, or if decisions are low risk but involve many comparable options. There are elements around AI capability maturity, basically how well do current AI systems actually perform the core tasks in your industry at a reliable and also a production-ready level. Now, let me be clear, with the current pace of advancements, it's very clear that AI's capability maturity should always be assessed dynamically. Everyone who follows AI's progression knows that we're not just seeing incremental updates. AI performance shows very large one-year jumps on several benchmarks, so take that into account. And maybe just there's a few things that I didn't discuss today, and that is that there are also factors that can temporarily protect your business from AI disruption. First one is the degree of customer acceptance. Here the question is, how comfortable are your customers with AI replacing human interaction? And of course, there's also regulatory friction. There it's about how much regulation actually slows down or constrains AI-driven disruption in your industry. Now, I want to mention that my personal belief is that regulation is often a delay mechanism, but it's never a permanent shield. Now, given everything we've discussed on the next slide, it should be very clear that an AI strategy is not just about a list of use cases. It's not just about deploying models. Instead, an AI strategy should be about rethinking how your company creates, how your company captures, and how your company defends value in a market that is increasingly shaped by AI. That means rethinking your business model, rethinking how you deliver value, and also rethinking your organizational structure. On the next slides, just a few more minutes, we'll dive into how to respond to these shifts and position your company for success. As AI is restructuring markets and giving rise to new competitive dynamics, AI transformation, in our perspective, needs to operate on 3 critical tracks. For those of you who follow BOI, you'll see that these tracks are the 3 tracks of our AI-first transformation, which we've laid out in detail in our AI-first playbook, and which we also consistently apply in our transformation work with clients. The first track is what we call strategic reinvention. And that basically means in an AI-first world, it's essential to reconsider where you play and how you win. And that includes the consideration of where your business model is most vulnerable or exposed to AI disruption, where scarcity and value really sits, what makes you hard to replace when AI can actually replicate so much. What are you selling and how do you monetize what you sell in a world where performance and outcomes drive value, but also who are you actually competing with in an AI-driven market? The second track, which we call workflow redesign, is actually focused on identifying where you can dramatically improve the scalability, the cost base, the overall economics of your delivery model. So there we look at things like which workflows are repeatable, high volume, labor intensive, meaning that an AI-first redesign can actually materially reduce human effort or shorten life cycle times or lower the marginal cost. The goal here is not incremental efficiency, but it's really about structural redesign. And then finally, as AI changes how you deliver value, it also becomes key to rethink your internal structure, governance, roles, responsibilities, your interaction models, but also things like culture, skills, capabilities, which is exactly what we do in the third track, which we call operating model redesign. If we move to the next slides, we actually had planned to do a deep dive in each of these tracks, but I also realized that this webinar has already been information heavy. Maybe very briefly, we have a framework which we always walk our clients through in the strategic reinvention of their business model. And it looks at 5 structural moves that can help expose businesses to actually defend value. I'm not going to go through these separately, but let me maybe discuss 1 or 2. One key move that many businesses will have to consider is how they can create an irreplaceable differentiated value through AI. That means embedding AI-driven insights, personalized experience into your offering so that customers can actually see your products or services as unique, even with AI interfaces or ecosystems. And I think a good example for me is Sephora, which has launched an AI-powered virtual artist, what we actually see in many beauty brands, but it creates an experience that is not just about price, but it's about a personalized beauty journey, if you want. And when customers feel that they're getting something unique or tailored, they are, of course, less likely to switch purely based on cost. So differentiation reduces comparability, and that protects margins. Another structural move is better utilization of proprietary data, if you have them. As discussed, data is a competitive moat in an AI-driven world, and it's not just about the massive data sets from the companies like Netflix or Spotify. It's really about owning unique or domain-specific data that others cannot replicate. I think about data from installed machine bases. So we work with Foundry business, for instance, to see how they can monetize that data, but also data from research, coaching sessions, assessments. All these data can potentially be leveraged to drive new services or optimize performance or provide insights that competitors cannot access. Maybe a very quick example is the example of a Dutch gaming entrepreneur. I don't know who has followed the news, but it's a Dutch entrepreneur who recently rejected a roughly 500 million acquisition offer from OpenAI for his company's video gameplay and data. So the guy had built up a massive data set from gaming clips and player behavior, which of course can be of huge value for training future AI models. And so he basically turned out a huge offer, went on to launch his own company focused on AI models trained on that proprietary video data. So very clear that owning proprietary data can become a very defensible moat in an AI world where generic outputs are easy to replicate. We're going to skip a few slides, make sure that there's at least room for a few questions. So Sine, if you would be willing to skip a little bit through to the last, this one is perfect. So I think with these final insights, let me leave you with one important reminder. If your AI strategy today is a list of use cases, If it's only about co-pilots or shallow tools or use case implementation, then you're most likely trying to optimize a business and an operating model that will no longer hold in the future. And in such a case, I would definitely recommend you to go back to the board, whether that's the executive board or the drawing board, and redesign your AI strategy around structural reinvention, workflow redesign, and operating model transformation. Because incremental AI may buy you a little bit of time, but it's definitely not going to protect you in a market that is being fundamentally reshaped. Thanks a lot for bearing with me. I'm very afraid to look at the comments because I'll probably see a lot of tips and tricks about slowing down, which I dramatically failed, but hope you still have a few questions that we can tackle together with Nick. Thanks.
Well, first of all, thanks so much. I think I have the attention span of a 5-year-old, and I was glued to the screen for the last 45 minutes. And about 200 people together with me. There's quite a lot of questions. I think that there's an interesting one that I see coming back from both Anna and Benjamin, which I think also applies to us. It's about what does all of this mean in the context of a professional services firm or for digital agencies and so forth. So maybe just to frame the question to you, how do you think about how this whole wave is disrupting our own industry? I think we saw in the last 5-10 years, a lot of agencies building software, trying to pivot to sort of a SaaS model. Increasingly, now we're seeing reports of McKinsey that's moving even more towards outcome-based pricing, agent-based delivery model, less junior analysts, and so forth. So I know there's a lot to unpack there, but love to get your perspective on it, and maybe just starting with, I guess, the most burning question: will the both of us still have a job 3 years from now? And I think you're on mute, Laura.
Yes, sorry. I actually have no doubt about us having a job, Nick. Might be overly optimistic, but I think we are not just advising clients, right? We're also applying our own frameworks to how we operate as an organization, meaning that we constantly scan where does real value actually sit for our clients? How can we actually leverage AI to operate more efficiently and effectively? And what does this actually mean also for our own team structure and making sure that we have sufficient leverage that we can actually fundamentally operate differently compared to traditional consultancy firms. So we're definitely eating our own food or breakfast and actively applying our transformation frameworks to our own business model and operating model.
Maybe just building on that, I think there was also a question from Malcolm, which was more in the legal sector, but I think it's a question that gets asked quite often, is if we are all indeed starting to rethink, and that happens across industries, right? Trying to rethink like the delivery model. Like what does that mean for more junior talents? Like how do young people get initial opportunities, and second, like how do you start building the expertise that we are now assuming will remain valuable?
That's a very existential question, Nick, in my perspective. I think, to be honest, what we see is that a lot of those entry-level positions are exactly those where AI is actually taking over a lot of activities. So I think for AI transformation, what we're actively doing is building more senior teams. That is the implication of that. All other questions for me, Nick, are actually quite existential and probably require a separate webinar overall.
Yeah, fair. I think those do position it more in the realm of politics and sort of the societal impact of AI, which I think we can spend 10 webinars talking about. Maybe shifting towards customer expectations and value perception. Like you spoke about content and value being sort of generated instantly. I think there was a question in the group from Chris about that. Like, how do you think clients or as a business, how should you think about like offering value towards clients, things that you were traditionally taking labor, so then means that you can actually charge money for it, which now just requires some CPU usage and essentially comes at a marginal cost of zero.
Yeah.
How do you see those kind of business models being impacted?
Yeah, so the exercise that we actively do with all our clients is actually, we call it the IP wall, basically, right? What are your unique assets that are not because a lot of companies had labor as a sort of a scarcity advantage, right? But now that labor is no longer a scarcity advantage, then every company now needs to reconsider what makes them unique. And it can be about, as mentioned, those proprietary data. It can be about deep integration in your customer workflows, which is a very powerful tactic, which a lot of companies are actively exploring. So how can you deeply integrate into the ERP systems of your customers? For instance, in case you're a material provider, how can you integrate with those workflows so that the switching cost actually becomes harder? Of course, there's also things like relationships, etc., but they will only. I'm not 100% sure if they will stand at the test of time. It's an active exercise for every company to think about their moats, their assets that make them truly unique and scarce to their customers. Yeah.
So maybe in your experience when you're having conversations, that sort of like exco level within. I know you're working a lot with telcos, for example, or utility companies. Like how much of a burning platform do you think there is for leaders? And do you notice any patterns about like type of leaders that are like really leaning into this, or certain sectors where you might say the urgency is less real?
Yeah, I think there's a huge burning platform, especially in data-heavy industries, right, where there's active monetization potential of those proprietary data. Of course, there's quite some challenges that I see as well. Of course, we have data quality, data accessibility, lack of informed consent, so that customers or people were never properly informed about actually being able to use or monetize these data, et cetera. But yes, there is a burning platform. What I see is that companies that are most successful and where I truly believe that they can make the difference is customers that are willing to, or organizations that are willing to step outside of that incremental mindset. So there's a lot of companies who spend the majority of their time on, apologies for my English, solving the shit of yesterday. That's a huge risk because as should be clear from this webinar, thinking about your business model or how AI actually makes you vulnerable requires deliberate time and to step outside of the comfort zone, also start planning for a more active transformation and kind of setting aside that idea of I just want to have quick wins and efficiency gains on the short term, because that's an incremental optimization question instead of a business model reinvention. So I think that mindset and that willingness to step outside of the daily comfort and the status quo is what will eventually make the difference. Mm-hmm. It's kind of a cultural thing. Yeah.
And wondering, because you spoke a bit about like some of the existing modes like channels, distribution, IP, physical products, and so forth, which I think in some industries are hard to challenge if you're a new entrant in the market. Isn't the risk more that your existing competitors are going to wake up early and take a more AI first approach to the problem? And I realized we were going to be cut off in about 40 seconds. So maybe a very short answer.
Very briefly, Nick, yes, it's a risk. And we see some companies are quite proactive and looking forwards, while in some companies, there's a board that is actually skeptical, cynical, doesn't feel the urgency. And so, that's where I'm mostly worried. And indeed, we know that their competitors are making steps, actively preparing for a broader transformation. So there's a real risk of indeed not taking that wave and leap and getting prepared for a more fundamental disruption. Yeah.
All right, then we're about at time. So maybe I want to thank everybody for joining. I want to thank you, Laura, for the really inspiring webinar. I'm dropping your LinkedIn in the chat, following everybody's example. Also drop my own. So if anybody on the audience wants to continue the conversation, please reach out. Feel free to reach out to Laura. Link is in the chat or to myself. And thanks so much, everyone, for joining. Enjoy the rest of your day.
Thank you so much.